Thanks very much, Alex, for that. Hopefully you can all see my presentation here that I will be running today. So hi, everyone, and welcome to this session where we're going to talk about how you build the foundations for growing your SaaS startup to a really large company. My name is Mikael Johnsson. I'm a co-founder and general partner at Aux, which is a specialist VC firm looking to back Europe's most promising B2B SaaS companies at the scale-up stage. That means we invest in companies that have proven their product market fit and are looking to accelerate through commercial and product development activities. Personally, I'm now in my 22nd year of investing in fast-growing tech companies, and the majority of that time has been dedicated to B2B SaaS. I've had the fortune to be part of taking companies all the way to successful IPO and trade sale exits, but also had the less pleasant experience of seeing companies fail despite checking all the boxes on paper. So my ambition for today is to provide you with a framework for how to think about your company's growth and how you set the foundations for building a really large company. So most of you listening to this are probably in the earlier stage companies, hard at work on building your company towards the $10 million ARR mark. That is definitely a relevant milestone where a lot of things change and you're widely considered by market actors to have proven yourself. However, I want to talk about what happens next and what you can do already today to increase your chances of building a really large company beyond 10 million ARR. But first, let's do a reality check. I've seen different stats on this, and they all have their respective strengths and weaknesses. But I'm comfortable to say with some certainty that less than 5% of all the SaaS companies started ever get to $10 million of ARR. So we're talking now about a massive selection of case of selection bias here. And in no way do I want to downplay the achievement in getting a company off the ground in the first place, let alone building it to $1 million or $10 million of ARR. Those are all massive achievements, and anyone who does that should be very proud of themselves. But to talk about then what happens next, companies that do reach that elusive $10 million ARR mark, even if they look essentially the same at that point, tend to develop along 3 different paths, and I've named them now the good, the great, and the iconic. So of course, everybody wants to be an iconic company, and the companies in this group, they really, really are. They do achieve several hundred millions or even billions of dollars of annual recurring revenue, and they continue growing really fast, even at massive scale. They tend to generally IPO and become very successful, long-standing public market companies. They also be consolidators going after really big market opportunities where they're global category leaders over a generation of software companies. Metaphorically speaking, these companies are the 1 in a million, and some of the names that would fit into this group are the likes of Salesforce, Slack, Snowflake, Shopify, and HubSpot. You get the picture. The next group is the great companies, and they also achieve real scale, several $100 million of ARR. They do take slightly longer than the iconic companies to get there, though, and they often have slower but still impressive growth rate at scale. These companies also often IPO, but some go down a high-profile M&A route, either as a private company or post-IPO. And while there are a lot more great companies than iconic ones, in order to continue the metaphor, they're probably the 1 in 1,000. Then there are the merely good companies. But just to come back to what I said before about the challenge in even getting a company off the ground and achieving some traction, by most accounts, these companies would still be considered a big success. But they do tend to flatten out in the low to mid double-digit ARR range and are usually scooped up by M&A consolidators. So if we plot the ARR development of the good, the great, and the iconic companies in the same chart, there are a couple of interesting observations. First, if we stick to the left-hand side of this chart and zoom in on the years 1 to 3, the companies do develop along very similar trajectories. There's only a very small difference between them in year 3. These are obviously illustrative numbers, but there's only a couple of $1 million of ARR difference between the iconic company and the good company at this point. But if we then switch our focus to the right, where I plotted the ARR for the 3 companies in years 3 to 6, the picture starts to look quite different. with the iconic company breaking out and the good one falling behind. So why is this? Well, there are probably as many explanations as there are companies, but a major explanation is that in addition to a strong product market fit, the great and the iconic companies have established a strong go-to-market fit, which gives them the foundations to growth at scale. So to set what we mean by go-to-market fit into a context, at Ox, we think about the SaaS growth journey in 3 different phases. It's first about proving your product market fit, then your go-to-market fit, and then it's about building the growth and moat. And this is a model which was crafted by Mark Roberge and is really helpful tool in focusing on the relevant priorities at the different stages of development and maturity here. I won't go through this in any level of detail, but as you can see, each phase has a different goal, which means there are differences in terms of how you should prioritize and what you should be optimizing for. I'm focusing here on go-to-market fit, but just to quickly cover product market fit here, having achieved product market fit means that you have proven that there is a sufficiently large and attractive market for your product, that you have an initial loyal customer base who are really hooked on your product as expressed in various engagement metrics. But above all, in SaaS, it means you have strong metrics around customer and net revenue retention. At Ox, we consider 80% customer retention, 100% net revenue retention, reasonable proof points if you're selling to SME on monthly contracts. That probably moves towards the 90% plus customer retention, 120% net revenue retention if you have more of an enterprise focus with annual contracts. Moving on then to go-to-market fit, and where product market fit is all about proving there are customers out there who value your product and that there is a sufficiently large number of them. Go-to-market fit is the next step in the model and all about proving that you can identify these customers, that you can reach them, you can sell to them, you can onboard them, you can renew them, and you can upsell them. And you can do all of that in an economically rational manner that provides strong return on the monetary and resource investments that you apply. In the 3-stage model, go-to-market fit sits in the middle as the bridge between product market fit and growth. And it serves as a reminder to prioritize the establishment of solid commercial platform before stepping very aggressively on the gas. If you decide to try and shortcut this stage and simply throw money at the problem, which we would refer to as blitzscaling, there is a massive risk that this will lead to poor decision-making, wasted money, missed opportunities, unnecessary dilution, and a lot of human burnout. So, if you buy into my suggestion that stepping aggressively on the gas without first ensuring that you have built those foundations through go-to-market fit, if that is a risky strategy and it significantly lowers your odds of building a really large company, what are the signs then that you still have some foundational gaps to plug before you start spending the big bucks and optimize for long-term growth? Well, the first sign that you still have some work to do, and this is the one that most people will be quickly identifying, is that your go-to-market related SaaS metric just aren't very convincing. Most people listening to this will know that the key metrics we look for measuring the go-to-market effectiveness in SaaS, they're the things like LTV to CAC ratio, CAC payback, and magic number. And there are a couple of different ways in which these metrics can be unconvincing. They can be generally unimpressive, as in your LTV to CAC isn't high enough or your CAC payback is too long. They can also be nascent, as in having only been proven on a very small customer data set, or perhaps only a small part of your overall customer base, or perhaps even on a very specific conditions, such as selling in only your geographical home market. And finally, they can be fluctuating and inconsistent, so that your metrics will depend very much on the time period observed, and forward predictability, therefore, will be low. The next sign is unclear positioning, which usually manifests itself in a couple of different ways. First is a lack of differentiation versus competitive alternatives. People essentially perceive you as similar or like for like to other alternatives, and you haven't made the necessary trade-offs to create clarity around who are you for, who are you not for, and how do you differentiate to other companies you're competing with. Effective positioning should not be a feature contest. There are a million different ways to position your offering beyond feature depth and breadth, which includes customer focus in terms of size, use case, vertical geography, Could be performance related, could be in pricing, service level, or customer engagement, etc. The list really goes on as long as your own imagination. Poor positioning also usually comes with a lack of strong understanding of your customer ROI and an inability to articulate that. Again, if you haven't really decided who you're for and how you serve them better than anyone else, it's hard to tell them what the true benefit of using your product will be. Yet another sign that you still have work to do around your go-to-market fit are long and unpredictable sales cycles. The actual length of the sales cycle isn't necessarily a fatal problem, as long as you have a high customer LTV and sufficient funding for working capital. For example, we have companies in our portfolio that are exclusively focused on very large enterprise customers, and where sales cycles can easily be 6 months or sometimes even 12 months. Obviously, if you're focused on SME, you want these cycles to be way shorter. But as I said, the real problem, however, here isn't necessarily the long sales cycles, but what causes real problems is when sales cycles vary dramatically and are generally unpredictable. This makes bookings forecasting very difficult and really complicates resourcing and recruiting on the sales side. So both in terms of getting the timing and the number of resources right, but also in your ability to predictably onboard and ramp new sales resources, which is a key factor for how quickly you can grow once the numbers start to become big. And to continue on the same theme, another sign you have work to do is that your sales rep success rate is too low. As in, too many of the sales reps you hire never make quota or quit or are asked to leave within a fairly short period of joining. This is such a critical factor because when you're growing at breakout speed, how quickly you can recruit and successfully ramp new sales resources becomes the key bottleneck that determines how fast you can grow. So what is a reasonable success rate? Well, as so often is the case, this varies with a number of variables, but for a transactional sale with an ACV at or below this sort of $10,000 mark, you really want to be hitting the 75% range or better. For more complex enterprise solution selling, this probably drops to 2/3 or perhaps even a bit lower in some cases. The point is, any improvement you can achieve here is going to be golden, and the importance of getting it right increases with your ACV and the length of your sales cycle. This one is perhaps a bit of a surprise, but if you're a fast-growing SaaS company doing real well, it's inevitable that you will have customers or prospects pulling in all sorts of different directions in order to fulfill their particular need. The temptation to build just this one little particular feature for a certain customer or to go the extra mile in terms of onboarding or customer service can be really huge. But in the long run, it really does pay off to stick to your netting. As an example here, I vividly remember an early board meeting in one of my companies that was only a couple of $1 million of ARR at that point, and where the probably largest possible potential customer imaginable to us came inbound with a desire to buy the product at a price that would be completely game-changing for us. However, they'd only do this if we made this very specific custom capability available for them. Luckily, this company has always been had a very clear vision and a super strong product first mentality. So after a number of days of thinking it over, we eventually said no. And that proved out to be absolutely the right thing because it allowed the team to focus on what they were already doing. And the company actually did really, really well of that and announced a large round of pre-IPO funding on this very day. So that worked out very, very well. And yes, you may have also second guessed it, but the big prospect actually is a customer today, but for the standard product, of course. So what are some of the things you can do then to speed up your way to reach go-to-market fit that will allow you that scalability in your go-to-market? Well, nail your positioning, I would say, is the first and perhaps the biggest one. Fast scaling B2B SaaS companies generally have a very clear focus in their marketing and sales-oriented activities. And positioning is really about deciding where to focus and where not to focus. And this comes in many different shapes and can be centered around things like customer size, industry, geography, a business function or a department, a partner ecosystem, a technology stack, or honestly, any combination of these. And generally, the sharper your focus, the better. It is much more effective to build 10% market share in an extremely well-defined market segment and then add the next such niche segment and the next, rather than desperately fighting for a 1% share in an ill-defined market segment and then trying to scale that to 10% by essentially shouting louder than anyone else. Everything you do at this stage presumes you can maintain attractive customer revenue retention metrics. So the beauty of SaaS is obviously the compounding nature of revenues, but that only works with strong customer revenue retention. And also, assuming you have designed your product and your commercial contracts the right way, it is a lot less costly, of course, to retain and upsell an existing customer who is familiar with the benefits of your product than landing a new one. So if you have high net revenue retention, you will be able to grow much faster with less investment than if you don't. We see a lot of companies who have built to a decent amount of ARR by selling on a combination of local networks, charm, and hustle. Unfortunately, that is very difficult to scale, and companies that have strong go-to-market fit have deliberately invested in a scalable and predictable top of funnel. It doesn't matter if this is product-led, if it's direct or indirect, if it's inbound or outbound, or driven by inside or field sales, or any combination of those, really. The key point is that the company knows where leads come from, what the cost for obtaining a lead is, and what the process looks like for refining a lead to a qualified lead, and how those in turn become customers. And finally, scaling a sales organization is very much an exercise in focus. People who specialize generally do perform better than people who split their focus, dabbling in many different things. In line with this, companies that have found their go-to-market fit will usually have adopted specialization within their sales organization, separating between sales development reps, whose responsibility is mainly to refine MQLs into SQLs, and account executives whose responsibility is to close business. They will also generally have implemented a separation between new account acquisition and upsells and the existing customer base. This where SDRs and account executives are focused on the new accounts, and a customer success team manages upsells. And other types of specializations that could be valuable and common are enterprise versus SME, direct versus indirect, and within certain verticals. And tying back to what I said earlier about the sales rep success rate, perhaps the greatest benefit of sales specialization is that it becomes so much easier to recruit the right people to the right roles. In general, this means the risk of failed recruitment goes down, as does the time it takes to onboard and ramp sales resources to full productivity. And ultimately, this is visible in a larger percentage of sales reps meeting or beating quota once they are fully ramped, which is the key to predictable scaling. And that was all I had for you today. Hopefully you've had some good tips and pointers that will help you build a really fantastic and successful company. And if you have any questions and want to chat about this, do reach out, and this is how you can reach us. Thanks very much. Alex, over to you.
Awesome. Thanks so much, Mikael. Fantastic presentation there. Super insightful. So thrilled that you could share that with the SaaStock audience. And great to see you got the go-to-market playbook coming out. So I'll certainly be looking forward to reading that. Your colleague Sasha mentions that you'll probably be dropping into Hopin to answer some questions. And so if that's the case in the scale stage, make yourself known in the chat. There's also some questions in the Q&A. If you hit the Q&A tab as well, that could do with some of your expert sort of wisdom. But yeah, really appreciate you joining us once again, Mikael. I look forward to speaking soon.
My pleasure, Alex. Thanks a lot. Take care.